Let me go straight across to Ravi Jakhar. He's the Director, Strategy and Group CFO of Allcargo. Mr. Jhakar, thank you so much for speaking with us this morning on NDTV Profit. You know, you've had your analyst day yesterday and a lot of focus on what the path ahead is. But before we do that, I just want to get your sense if you're seeing any impact of tariffs right now. For any company in the logistics space, this is also a big issue. So let me start there before we get to the takeaways from your analyst day.
Yeah, so I think, speaking on tariff, what we are noticing is that there have been disruptions and volatile patterns in trades. For an example, when China tariffs were announced, we saw a sharp decline in China volumes, which then picked up again as the policies got reversed. We have seen impact on India to US trade. But if you look at the global landscape, what we're finding is that month on month, and we do release monthly updates on volumes as well, month on a global basis, we are finding largely steady volumes. So there are pockets, primarily exports into US, which have been declining, and exports to other destinations from Asia have been generally increasing. Having said that, if there was no disruption of tariffs, perhaps you would have seen some growth rather than the volumes being flat. So I would say the impact is that on a global basis, the trade is not growing. It's remaining flat for us. And in terms of specific segments, trade into US has been declining. That's how I would read the impact.
What would be the strategy then, Mr. Jhakar? Just trying to, get a sense of what your mindset is right now, because all companies need to realign in that sense with what is happening right now. So is there more of a domestic focus? I mean, how are you going to tackle this going forward?
Yeah, so one good part with us is that we have our own offices in about 70 plus countries, which means that only a part of our business is linked to India as far as the international trade is concerned. So when cargo flows change, and if India volumes are to go down and Vietnam volumes are to go up, or contrary, if China was to go down and India was to go up, we are able to realign our trade lanes as well. Being a global company with significant market shares in almost all the key consumption countries and all the key production countries, what we notice is there could be fluctuations within what trade lane is working well for us. But on a global basis, we are well covered. Unless the entire global trade was to come down, that is the kind of macroeconomic impact which would affect us as a company. A country-specific, restriction or decline generally does not impact our international supply chain business.
Mr. Jhakar, good morning, Neeraj here. And how easy it is, and I'm sure it's not easy, but how is it that in the current scheme of things, are companies able to guide for possible revenue, EBITDA performances over a 5-year period? I think it's difficult to figure out what will happen over the next 5 months, right? So I'm trying to understand, how did you guys come up with this CAGR growth estimates for till FY26 to FY30?
Right, no, absolutely. So I think if you go through the presentation, which we also shared yesterday, we have provided guidance for FY26, which is the current year. We have also spoken about FY28 in the domestic business, which is 2 years down the line. And we have spoken about only FY30 as the only number in all cargo terminals, which is a long-term gestation projects business, where we are developing some new infrastructure projects like an ICD in Farrukhnagar, which will only take a couple of years to materialize. And therefore, the long-term guidance becomes more essential than the near-term guidance. And if you look at the all-cargo terminals business, there is a pretty steady business. India's exports and imports are bound to grow well. There could be some marginal impact on the trade with US, which I also feel is more near to midterm at best. And the industry is running at very high utilizations. And given our market leadership and competitive positioning, it is more infrastructure development-led revenue and cost visibility, which is also very certain for us. We have fixed outflows across all the 7 existing facilities and the new upcoming expansions as well. So we have a very clear roadmap ahead in terms of what infrastructure gets ready when, what volume capacity kicks in. And given the overall market situation wherein the market is operating at a very high capacity utilization with a lot of port capacity coming in and the growth story intact, I think it is much easier for the all cargo terminals business to predict how the outcome of the capex and the new projects and expansions will look like. Coming to the domestic supply chain business, that is again more driven by the domestic consumption on the all cargo gati and on the all cargo supply chain, which are now also, of course, coming together. We had our final hearing day before yesterday, which is now concluded as a process, and we expect the order very shortly. So perhaps effectively as early as next 4 to 5 weeks, we should see the demerger being implemented on the ground. So on the domestic side, with this GST reforms as well kicking in, we are clearly seeing increased consumption and increased trade flows. The month of September continues to be a very strong month. On the contract logistics, our pivots are a chemical industry, which is more specialized, and e-commerce and quick commerce, which again has been growing at a very healthy rate. So I think on the domestic business, the approach on the projections is more like an annualized growth rate, and it's not like an absolute far-out 5-year target in case of Allcargo terminals, which is more projects-driven. So in Allcargo, Gati, in the domestic business, we have spoken about what kind of compounded annual growth rates do we expect over the next 2, 3, and 5 years. And that's largely driven by the operating leverage. There's an Indian economy growth, the market growth, and we're not looking at a significant expansion in market share, but more of operating leverage by controlling costs, which has been playing out for the last 3 quarters as well. So it's pretty scientific in that way.
Fair call. Just one quick a question on how do you see the economy linked pieces right now, because you may be doing certain parts of this logistics supply chain, not all, but you may have a view, you will have information on all. Is there brisk activity starting to happen because of the consumption boost, but accompanied by some bit of exports or imports being lower? How do you contextualize the two?
So what we are witnessing is that there is a selective decline in trade from India to US, which is impacting certain industries. And there are a few industries which are heavily dependent upon the US exports. So those are badly hit. For instance, a lot of exports on the gems and jewelry, on the textile, and there are a few industries which are, I would say, severely impacted, and they are hoping for some kind of reversals and negotiations taking place over the next 2-3 months. And if that was not to happen, there could be severe impact on those industries, at least I would say in a 12 to 24 month period, maybe over a longer period. If this was to be a long-term phenomena of, sort of preventing Indian exports, they could find alternative markets, but there would be tough times for 1 to 2 years for those selective industries. Now, as far as we as a logistics company are concerned, we don't play much into these high value commodities, which are largely driven by air freight. We're not focused on the cross-border e-commerce that much. The kind of business that we do, containerized LCL trade, that is something which is more steady cargo. When the volumes go down, FCL converts to LCL. When the volumes expand, we see industry tailwinds. So, which is why if you would see over the last several years and also specifically quarters and breaking down into months, we usually see more consistent volume flows. What is happening is that, like I said, ideally with the inflation coming down, there should have been more disposable income. We should have expected the trade to rebound both into Americas and Europe. Unfortunately, tariff has put brakes on that growth path. So to give you an example, we would have expected about 800 to 810,000 cubic meters of cargo, which would have been a substantial growth over the past few months. But we are still seeing about 750 to 775,000 cubic meters of LCL cargo in our business, which is more or less steady or marginal growth. So there's an impact, but I believe personally that this impact is more near term, and which is why, if you ask me, there could be more volatility in the next 6 months. But when I look at 12 to 18 months down the line, I believe the business should be more stable. That's how I see it.
That's why targets are being looked at from an FY28 perspective. Understandable in the world we live in. Just trying to understand if there is any kind of insight on the post-GST cut volume that you're seeing, since e-commerce also is something that dominates your revenue mix. And of course, this will be from a domestic perspective. Are you seeing any uptick there?
So on the domestic business, I would say over the last 18 months, we have seen a tremendous increase in the quick commerce business. And it used to be a small part of our business, and now perhaps is the largest business segment already in our contract logistics segment. So that's something which we are finding it's possibly becoming a habit for customers. And we see the quick commerce part, which is now growing much faster than the overall e-commerce. We see that fundamental shift continuing to happen over the next few years. And we see that having an impact on our business as well, creating opportunities and managing dark store, last mile supply chains linked to the quick commerce. On the overall GST, we clearly, like I mentioned, we are witnessing stronger volumes. And these are essentially, if you look at the lower priced commodities or the essential commodities which have largely been impacted, the auto sector seems to be benefiting a lot, which means there would be increased auto components, and after service spare parts market should expand. These are some of the segments which, from a logistics perspective, are part of organized market. For example, the organized market does not play that much into the agri-logistics, for instance. So it's not directly dependent on the monsoons, though indirectly consumption gets impacted. But if you look at the GST impacted areas, most of these are mass market commodities traveling in the domestic hinterland in an organized logistics framework. So that's something which should benefit us and the other logistics players also in the market.
Okay, thank you so much, Ravi Jakhar, there of Allcargo Group, in that exclusive conversation with us. The company had its investor day yesterday, and that focus has definitely been there with a hope of improvement by 2028. But as any company in the logistics business, what is happening with tariffs and a global trade war will weigh heavy as well.